My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain this crazy market. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. We have one wild market today where everything that had been doing so great this year suddenly pulled back. Sell. While other stocks that have seemed to have run out of oxygen suddenly sprung back to life, giving you huge percentage gains. Now, that's bad news if you own the high-flying stocks that have defined this tape so far this year, many of which are trading down even further in after hours. Companies like Microsoft, Alphabet, AMD, and they all came in red hot this week. But it's good news for a lot of the cheap old-line companies with stocks that have done nothing since December, which is how the Dow could advance 134 points today. S&P dipped 0.06%, but the tech-laden NASDAQ tumbled 0.76%. Yep, we had a whole bunch of high flyers open up big this morning, only to give it back, and in many cases more so. However, we had a host of incredibly inexpensive stocks. I'm talking about Wells Fargo, General Motors, JP Morgan, Nucor, the largest steel company in America, which is all Mad Money tonight. They took off as if their collective hair was on fire. Now, periodically, you get reversal days like today. Let me give a particular example because it's on top of my mind after last night's interview with Charles Liang. He's the CEO of Supermicro. Here's a tech company that put up spectacular numbers, much better than expected. Lights out. It was the bell cow for today, the one in the lead, the one that showed you artificial intelligence spending is real and it is tremendous. The trajectory of the stock, though, tells another more negative story. When the print, as we call the press release, came out last night, the stock jumped 10 points, then 12, then 15, next up 20, all after hours, mind you. When I got home, Supermicro was trading up 30. I got up early to watch the stock rally some more and didn't let up until it was up $60 this morning. Sure, that's exciting. And the pin action it generated? Holy cow. For every stock with an AI connection, it was breathtaking. Stocks like the pins were flying all over the place. It was an earth-shattering strike. There was a problem, though. After we got the strike, there was no follow-through. The great roll was followed by, well, nothing. And when you know it, Supermicro finished the evening almost, yes, that was a joke, just a sec, I've got one of those too. Almost where it was when it reported that monster of a number. In the meantime, we began to see a parallel levitation in another area of the market. Levitation in the banks, in the steels, and the autos. No, this time it wasn't a bowling match. What we got was good old-fashioned volleyball, a rotation out of stocks with lofty price earnings multiples and into the cyclical stocks that traded 6, 7, 10, maybe 12 times earnings. Take GM. Here's a stock that's not just historically cheap, but 4 times forward earnings cheap. I mean, the average stock is selling on 20 times earnings. That's what this one's at 4 times earnings. As CEO Mary Barra laid out a $9 earnings per share forecast for the year this morning, I'm sorry, but anytime I can buy shares in a very solvent company at 4 times earnings, I'm going to do it. And to raise the money to pay for the 4 times earnings GM shares, I will sell shares in a company that sells at 40 times earnings. And that is what I think happened today. I say that because there's not a lot of money coming in, giving you how you can earn 5% on your cash pretty much risk-free. That money cannot be enticed into what looks like a charnel house for tech. How about the banks, though? Today, Morgan Stanley told you that because some new regulations will be less restrictive than expected, the bank stocks are going to make a lot more money than you think. That means a stock like Wells Fargo is only selling for just 10 times earnings, 2.7% yield, mind you. Again, far be it from me as a former trader to be in a software stock that trades at 60 times, 70 times, 80 times earnings, or has no earnings at all, as many of them do. When I can be in a stock that trades at only 10 times earnings, it's going to be a real nice dividend. Nucor, steel company, which we're fortunate enough to have on the show tonight. This steel maker, largest in our country, largest in the world, frankly, but of the ones that are not subsidized, is at the forefront of everything infrastructure. Was selling for roughly 13 times earnings last night when it blew away the estimates, levitated to much higher levels, adding $12 or 7%. Now, we've seen this before, so we have to ask ourselves, what games are really being played in this market? Is it really a game of bowling, where the pin action was tremendous, but there was no second frame? Is it really a game of volleyball, as traders rotated out of the front row and headed into the back row of earnings? The cheaper positions, no more spiking. Maybe it was a game of front seat, back seat. An isolated event, nothing too serious, almost whimsical. Some sort of end-of-the-month game where we looked at the performance disparity this year, then opted to take profits in what was flying too close to the sun, our Icarus money, and putting it back to work in terra firma with Nucor, GM, and the banks? No matter what game we were playing, it caused some damage that we need to talk about. Let me put my technician hat on for a second. We do off the charts for the chartists. We always ask them what they're thinking. It's important, not because I want you to be a technician, but because part of being a good investor is curiosity about anything that can move a stock: earnings, sector, interest rates, Fed policy, gyrations. Yes, actual gyrations that can impact the thinking of a whole cohort of traders. And the chart says we're looking at some dreaded island reversals in the world of tech. Whatever game impacted stocks, bowling, volleyball, front seat, back seat, left in its wake some very broken island reversal charts. They're damaged because whenever you have a stock that jumps up at the beginning of the day and then plummets to chart watchers, you are having a Humpty Dumpty situation where all the king's horses and all the king's men can't put that stock on the right trajectory again because islands reversed. Now, normally I wouldn't be too worried. I know I'm analogizing all over the place, but the major accord in this market has been to own the stocks of companies with amazing earnings, regardless of what you pay for those, right? We don't care. Growth stocks reward you longer term. Nothing else does. I mean, GM wouldn't sell 4 times earnings if anyone thought it was a growth stock. But to have the minor accord surface in front of a Fed meeting in the thick of earnings season with results that only reward the downtrodden, yes, indeed, that, for many, is worrisome. You now have plenty of people worried that we're in for a bruising no matter what numbers the richly valued stocks report, a view that the after-hours action supports. That's why we need to focus on tonight's earnings, even though we don't yet have the full recollection of them or reflection on them. I'm talking about Microsoft, AMD, and Alphabet. Here's what we know so far. Microsoft posted a nice top and bottom line beat, tremendous 30% revenue growth from its cloud business, and 6 of those percentage points came from AI. But the stock came in real hot, maybe too hot. AMD hit you with a discouraging forecast. Real weakness in the programmable chip business. That's one they picked up from Xilinx. Stocks crumbling after hours. Alphabet posted what looked like a good quarter, except their advertising revenue disappointed some. Even as I thought the cloud business had a nice snapback. Par for tonight's course, it too is selling off. So are these all island reversals that are just too difficult to overcome, where the stocks opened up big and then plummeted? Or is tech just taking a breather until some of that juicy money from the sidelines takes advantage of the first price break of 2024? And it is the first price break. Bottom line, like I said in Friday's game plan, there's just too much noise here. Let's just wait and see. Let's sit on our hands and process all the information coming at us before we take any action. I am telling you, it will be well worth the wait. Let's take calls. Let's go to Tom in Florida. Tom.
Hey, Jim. Thanks for everything you do for us. I'm a longtime watcher. My question is now an okay time to get into REITs or residential REITs now that interest rates might be softening soon?
Well, what I've noticed, Tom, is that there is now grave disparity among the REITs. And the residential REITs, I mean, the one that I always think about, Avalon Bay, just okay. I'm not going to rave about any of these. And I'll tell you why I'm not going to rave about any of them. They've had big moves. I mean, they've had these huge moves and off the bottom. Now, you can still say, well, Avalon Bay gives you a 3.7% yield. That's not enough for me. That doesn't entice me. So I'm going to have to say no right now. Of the REITs, I do like Federal, FRT. I do like Simon Properties. And I do like Realty Income, letter O, at 5.5 with a monthly dividend. Sam in Colorado. Sam.
Jim, how are you doing?
I'm doing well, Sam. How about you?
I'm doing all right. You know, Jim, one of the stocks that I think is one of the most important companies in today's world is Taiwan Semi. And looking at NVIDIA and AMD, we're talking about a combined market cap here of over nearly $2 trillion. Right. So TSM, with their $534 billion market cap, this is the company that all of the chip other companies depend on. Don't you think TSM should be valued more?
Yeah, I do. It's got this great political risk. That's the problem. I mean, you've got a presidential candidate who many people feel like would not necessarily jump to defend what could happen to Taiwan. Other people think he would. You've got a president who has antagonized the Chinese into thinking that maybe they should take action in Taiwan. I mean, all of it's a mess. Here's what I think is really happening. Nobody knows. And that's why Taiwan Semi is a hard stock to own. Let's go to Mike in Connecticut. Mike.
Jim, thanks for taking my call.
My pleasure.
I want to take this opportunity first to thank you and staff again for all your wisdom with the books and the TV show, which just made me so many great successes.
Oh, you're great. You know, and look, I don't know these callers, okay? I mean, like someone the other day was saying, hey, Jim, you put these guys up. Are you like kidding me? I haven't put anybody up to saying good things or bad things about me since 5th grade. That was the last time because I hit a principal with a snowball. and get some people who testified in my favor. I needed that. What's up?
Jim, this stock I find so much conflicting information about. I can't figure out if they're trying to underestimate so they can over-deliver, or it's something I should stay away from. It's CAVA.
You know, I happen to think that Kava is going to be one of the great growth stories of the era, and I think that because they offer food that's good and good for you. Now, they definitely have to get their act together when it comes to the letters that you see in front. Letters, the grades of the sanitation, the health and sanitation do tell you something, having been in the restaurant business. But I think that Kava is here to stay, and while it is expensive, you know what? Chipotle was never cheap either. Anyway, the games that stocks are playing are difficult to parse right now. We just can't be sure. And it's hard to tell if some of these moves will be permanent or they're just temporary. You know what? What does that say you should do? How about sitting on our hands and process all the information coming at us before we take any action? Mad Money tonight. Cisco, that's CSYY, comes soared today after earnings, giving investors a decent read on the state of the consumer. I'm breaking down all you need to know with the company's top brands. It's restaurants, stupid. Then I have a tale of two credit card companies, Capital One versus American Express. Is it possible for both of them to remain winners in the same industry? I'm going to give you my take. And was Nucor practicing a classic case of under-promising and then over-delivering when it reported? I don't know. Maybe it's just blowing out the darn numbers. I'm learning about how disappointing guidance led to a strong quarter that sent the steel maker much higher today. I mean, like, much higher. You do not want to miss my exclusive with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.